Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone gliding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout this show. Well, the stock market lost ground this week as cross-currents of the news of the coronavirus and earnings reports brought a very choppy market. Monday saw the market decline overnight, Sunday night actually, as China did report that the spread of the virus was much worse. Tuesday saw a rebound as market participants who are desperate for a downtick bought the market on that opportunity, and they got help from strong numbers out of housing and consumer confidence. And then the market, of course, waiting for the Fed on Wednesday, and the Fed was pessimistic on the economy, talked about potential downside risk, and said they were watching the coronavirus. They said that they would stay in their temporary repo operations until at least April. If they told the truth, and I don't think that they do at all, they would simply say, we are in QE4. We have no idea how much help the repo market needs, no idea how long we have to keep building our balance sheet. We're at 1.5% interest rates, and of course, this is in crisis mode, and we've been in crisis mode since 2007. They can't normalize the markets, or they would crash, and they should say that. And the proof of it is 2018, when the markets moved down so sharply when they tried to tighten. And they should say, we at the Fed created this horrible situation where we can't control anything, we can't step in the way of dealing with real problems, and we've allowed government debt to get out of control. And we need a plan to change the role of the Fed. If they were truthful, those are the things that they would say. Well, markets fell late after that presser from Powell on Wednesday, and fell into Thursday morning. They did stabilize. Then the news came out about Q4 GDP at about 2.1%, but that's a bunch of hocus pocus numbers because the trade numbers are inflating that. And the EU came out and they reported their Q4 growth only at 0.1%. So the markets were weak in Thursday, and then with the S&Ps down about 30 points, news came out that WHO declared an emergency. Well, they're not using the word pandemic, but just an emergency, but still they're saying that, maybe you shouldn't fly to China, but they're not willing to do anything about mandating anything around travel or mandating anything around trade. So they're kind of sidestepping what is a pretty bad emergency. But obviously, that was bullish as the S&Ps that went from down 30 to up 20, a 50-point reversal there on Thursday. And maybe it's all about the fact that, well, if we have these slowing economies, and we have this horrible situation, and in crisis mode since 2007, maybe the Fed's just going to ease some more. So buyers came in and pushed the market up, but that did not last. Friday kind of looked like it was going up in the morning as there were blowout earnings from Amazon. But worldwide markets, they were weak and really getting weighed down by this the prospect of the coronavirus spreading around the world, very weak, and the market re-entered free fall as we saw the S&Ps down 50 points here at midday as I'm beginning this recording. With all this news, The surge in the cases of the virus, it's spreading internationally, with socialist Bernie in the lead for the Democrats, and the stock market, huge valuations that we have, and stretched PEs, just extremely high. We're still only 3% from a top. And bulls are looking, at the past, that they've seen this market dip, and they're just simply ready to buy. So we get these huge swings in the market, 50 points either way, and of course, implied volatility, as we suggested, significantly higher and likely to stay that way for quite a while. And all of this movement, everything we're seeing, all of this background news, all of that, well, that doesn't affect our analysis. And that was for a market top here in late January to early February. And that the risks to the downside would be much bigger. Well, we're seeing that now as the market is weakening, and they're looking at this yield curve, which is inverted again and suggestive of a worldwide slowdown, very apparent. And the Fed is, I believe, going to be forced to start cutting interest rates again. They can't let this yield curve invert and scare everybody, but they're going to scare everybody anyway as they start cutting interest rates. So they're going to want to get that short end lower so that they can uninvert the yield curve again. And they're going to be in a position where, when the crisis hits, they got nothing left. Maybe negative interest rates are the way we're going here in the U.S. Well, we still see two waves on the downside in the stock market. One now, which we see is quite apparent, and probably a rebound when this one is over with, and we'll talk about targets on the downside later in the show, and then another one into the summer. And overall, our prediction for this year was that at worst case in the summer, they'd be down somewhere between 8 and 12%. Somewhat of a mild correction, and probably held up by the fact that the top of this market might take a long time to form, and it is an election year. And election years tend to be up, though we think this one will be a small down year. Stocks for the week, they're down between 1 and 2%, depending on what index you're looking at, though the EU did have its worst week in 15 months. The bond market, we saw the 30-year bonds move up 3 points, and note the 30 years are approaching to get below that 2 handle into a 1 handle. The 10 years down to about 1.53%. Remember, the all-time low here was 1.34% in the crisis, so we must not be out of the crisis, right? 15 basis point decline in that 10-year, and the 1 to 10-year yield curve is inverted by about 3 or 4 basis points. And it may not be long before the 2 to 10s get inverted again. The dollar down about 0.4%, and it is weakening now. Now it had a bid as a flight to safety, and that seems to have ended as there's selling now coming in the dollar, and that is related to the fact that worldwide interest rates, well, they're at 0 or below 0. U.S. interest rates are starting to close that gap. And when that happens, well, then our currency gets weaker because that gap starts to close. And if you want to know, well, how you might trade that, take a look at our trade idea in the euro currency, which is inversely correlated. We posted that today for our level 3 and 4 members. Oil, well, that's down about $2.70 on the week right now. That's $11 down in 4 weeks. And it is a total debacle in the whole energy sector. Just a ton of weakness there in oil. Follow me on Twitter at askSlim. Become a YouTube subscriber of our channel. We have a ton that we're putting out now in YouTube. And give us a thumbs up if you like this video, because, of course, we're giving you a ton of information, and we don't charge you anything for it. So now what I want to do is I want to introduce something to you, or reintroduce, just because we have been working very hard. This is the announcement of the Slimulator Momentum Tracker for investors and long-term swing traders. We have been working so hard on this program. We brought it out for a little peek before, and now we have have done a ton of work on it and ready to bring it out for you to look at for a beta period. What is the Slimulator Momentum Tracker? Well, what this does is give you a solid grasp of current momentum conditions, which is critical to trade planning and position management. The new Slimulator Momentum Tracker is infused with our proprietary momentum indicators that we have refined over decades. This is an amazing program, and what it offers to you is an instant look at the health of price action of individual stocks and ETFs, a clear picture of momentum in multiple time frames. So you get to see it in a longer term, intermediate, or shorter term, and there is so much more in there. I have so much to show you about this. The key features to the Slimulator Momentum Tracker, which again is for momentum traders, for investors, and for swing traders that have a little longer holding. These key features are access to the askSlim proprietary momentum readings on more than 1,000 stocks, and that is going to grow, and ETFs in multiple time frames. The program generates a directional bias and outlook to support active investors and long-term swing traders. Search and review the momentum conditions of a single symbol or your choice to build your own watch list or one of our pre-installed watch lists. Easily sort and find symbols with the most bullish or bearish overall momentum conditions, or symbols that are bullish or bearish at specific time frames. The key takeaways here is you want to reduce your risk with the new Slimulator Momentum Tracker. Use momentum to be better informed and prepared for trends that may be more likely to continue or that could have trouble ahead. Raise your odds of being on the right side of the big moves, and of course to avoid being on the wrong side of them, and improve your timing by cross-checking the current momentum conditions with your assumed directional bias or your analyst. So we're doing this and we give you this to support your work. Let's take a deeper look at the Slimulator Momentum Tracker as I put that program up for you to see and for me to demonstrate. This is the Momentum Tracker, and this is just an amazing program. So I want you to see there's a lot in here. There's a symbol search where we do our put our symbol in there. You can look up single symbols, or you can pull down this watch list selector and look at our pre-canned watch list that we have in here. So what you see in here right now is I just happen to put Apple in, and there's the company name, and the directional bias is very bullish. You can see that. What that comes from is our algorithms that are in here that are long-term, intermediate, and short-term. You can see that they're all green, and they have been that way. And of course, we've seen Apple moving up very strongly. The investor outlook for the next 3 months are strong positive conditions suggest minor declines in higher prices. So yes, we're looking at corrective periods in here, but that does these all suggest that there isn't likely to be any extended or continued momentum conditions or declines that these momentum conditions suggest can stay in place. So you can see in here we have Apple. If I put in a stock that happens to be negative, you can see in here Exxon. It has been very negative for a long period of time. There's ExxonMobil, very bearish, weak conditions for the next 3 months, negative conditions, failed rallies and lower prices, and you can see what Exxon has been doing in here. There is so much more to this program. It is incredible. So what I'm going to do is I'm going to go in here and I'm going to say, well, create my own watch list, and I've done that. And I have my own watch list right in here. I just happen to put some things in there to look at. And this is what's amazing, in that you see right over here, it calculates what the percentages are in my own watch list of stocks that are very bullish, that are neutral, or very bearish, within that particular watch list. And you can look at it based on different time frames. So if I want to look at it on the long term right over there, I switch it and it calculates long term. Let's switch over to a bigger watch list. You can see the S&P 500. It'll take a second to load this up, and then every 15 seconds or so it does update. So there you can see the whole S&P 500 in there. The momentum, if I look at the momentum for the long term, 69% of them are still bullish right now. Of course, we're only 3% off the highs in the market at this time. 18% are bearish. If I want to look at the short term, well, we've been going into a correction. Look at that now. 46% are in negative conditions on the short term. This is updating right now, and it switched over to the intermediate term momentum that you can see right there. And now if I want to look and say, well, which are the best stocks long term, I can just click this little arrow right there, and you can see it went to the worst stocks actually, and click it again, and it's going to go to all green, or the best stocks. You can see in here, Apple, of course, is one of the best stocks right there. Abbott is one of the best stocks. Just fantastic when you look at that. If I want to isolate out a stock in here and I click on Apple, I just go right over there and it brings Apple back. This little I symbol there tells you that it's on single symbol view, and I can just go back and look at the whole list. Amazing. Now let's say that I want to look at the XLE, the right over there, the energies, and it puts up the entire energy group. I want to look at the momentum indicators for the long term right there, and you can see half of them are in negative, only 14% are in positive condition. And for the short term, there are, let me just look here at short term. Look at that, 89%. That's getting pretty extreme. We're going to work in a way to back test this and know when things are at extremes, or the dates that things get positive or negative. We're putting so much in here. So that's the energy. You know, if you look over here and look at the financials, let's go to XLF and just take a peek there. You'll see, well, the XLF, let's just go to the longer term conditions. 80% of those are in really, really good shape. And you'll be able to look at or look for which are the best and worst. There's AMG, you can see that. Very bearish, weak conditions, say failed rallies and lower prices. And I can just scroll to the better ones right over here. Let's just see if we can get anything with 3 positives across. There's Arthur Gallagher right there with 3 positives across. That one is still a very good stock. Allstate, still a very good stock. AMG, look at that. That's all those reds right there. Aon, all positive. You can see fantastic information. You want to get more, you can go back to the single symbol search. You can look up anything you want. There is Netflix, and instantaneously gives you the conditions. That is the amazing, amazing Slimulator momentum tracker. There is nothing like this out there. This fantastic information that we bring to you in this, and you can have this. You can test this. We want you to, as a matter of fact, to take a look at this as we begin the beta testing here. You can become a free member. Now, all of our members will participate in this, even the free members. So you join us for the beta testing in February. Go to askSlim.com if you're not a member and sign up for a free account. All members will participate, and we want your feedback, because that's how we're going to improve this even more. This is going to be such an amazing program, and it is going to be included in all levels. And for level 1s, it's going to be an amazingly low price per month. But for right now, while we're in beta, there's no credit card necessary. All you have to do is sign up or be a member in any level, and it will appear in your dashboard after February 6th. That's where we're going to be ready to put these things up. Any questions that you have, well, just send those to Matt at askSlim.com. Matt just knows this stuff so well. He's so fabulous. Matt is, if you get our stock index reports, he's the one in charge of those and doing fantastic information, giving you that. So he is just really good, and you will be able to get real clarity if you have any questions on this. Remember, free, no credit card. You'll beta test it for us when we bring it out. That'll be for about 2 weeks, and you can just sign up and help us with that. That is a look. Now we're going to switch over to our best and worst stocks for the week. So this was a really crazy week because there are some stocks with some really big moves. Let's take a look. I'm going to move out of this SPY right over here, and I'm going to move over into the first stock we're going to look at, which is Navistar. And I'm going to put up a weekly chart, and you can see that. What is that? That is a 50% gain. And what is this crazy timing that it came at? Look at this. Look at the cycle brackets in here. Those tell you the average length of cycles. And each time you get into these rising phases is when you get the upside moves. You can see that. This came exactly on time. This buyout from Volkswagen or one of the Volkswagen subsidiaries, they're going to pay $2.9 billion in this takeover, and that's what this big gain is. It came exactly off that 78.6, exactly at the time that low was due. Pretty amazing how that sometimes the news fits these patterns so well. 50% gain on the week for Navistar, and that one is going to come out of our universe. Tesla, well, that just absolutely ripped the shorts on the upside in here. This stock beats on earnings in a big way. This has a forward PE now. It actually has a PE. Before it was just going up with no earnings, and now it has a forward PE. The projection is over $7 for this year. That puts it at over an 80 PE right now, 80 to 90, and that's pretty high. Of course, the projections for the following year in 21 are for about $13, so they are now they're pricing in 2 years down the road. When you look at this, and 250% gain in the last 3 months. Valuations have to be an issue. Analysts are all raising their targets. Now, what's really funny is that Bank of America raised its target to 370. Here's the stock trading at 642. Pretty amazing. Pretty amazing how bad some of these analysts are. So that is a look at Tesla's 17% gain on the week. Just absolutely fabulous. Amazon, AMZN, the next stock we're going to look at, another big earnings move right there. Who would ever guess that you would have a day when Amazon is up 158 points, $158? That's a massive 8.4% gain, up 12% on the week. Big earnings, analysts upgrading the stock. On this day, the S&P 500 is down 50 points. What an absolute wild thing when you look at that. And what we have is a NASDAQ down 200. Again, I'm telling you that this is one of the wildest discrepancies I have ever seen, as Amazon up 158 and the stock market getting absolutely crushed. Who would guess that? Amazon getting up to those old highs and just above it right now, making a new all-time high. And what you see in here in our projections is that there is an intermediate correction due. Now, what we're going to look for is a decline into these support zones down over here under the maybe 1977, 1968 right over there. Those are buy zones right in there, and so that's just really not a very big dip when you see this stock at this price. And we could, we're looking at $50, $70 on the downside and getting into that buy zone right over there in Amazon. So a modest pullback expected in this nested area right over here, and then moving up right in this one right over here. And that's the projection for new highs coming out there after this corrective period. Remember, the stock market, maybe another 3 to 5 weeks of correction now, and then another rally. Well, we think that Amazon will lead that on the upside for new highs. Deckers, DECK, wow. It comes up and hits that fib target right up over there. They gain 12%. Big earnings beat. Analysts upgrade this stock. And again, we're looking for a correction, probably on the modest side, getting down here to this level right here is about 190. This one right over here is about 183. So that's what we're looking for, a pullback into that area over there. And again, another upside move, as this is a very bullish pattern. Now, I want you to know, when you get these upward configured cycle rhythms that you see right here, here, the odds are that the next one will go to a new high, as it did right here. This one's going to obviously configure in a positive way, and then we'll go to a new high. So you can see this one, positive, new high, and then a new high, but then a failure, and it didn't make a new high. So that's how you learn to read these cycle patterns. And do subscribe to our cycle analysis workshop, and you're going to learn a ton. 20 videos in there, 15 hours of watching, and I'm going to teach you cycle analysis. We have some members that have watched that 3-4 times fully, putting 60 hours of work into it, plus doing their own cycle analysis on hundreds and thousands of charts. So really some people working very hard on learning this kind of analysis. Square is next, and this stock I really like. PayPal has a similar pattern, and that is you can see that it is beginning to form a bullish pattern. And the rhythms in here are very clear. So you see the low right over here projected in the nested area, that low right over here, the low here, and the low here, those all line up. So there's a low due here in about 2 weeks, maybe 3, pulls down here into this upper buy zone, and then moves up to a new high. This is an expensive stock, but the earnings are growing, and it gets a big upside move on no news in here at all. The earnings don't come out till later in February, and we think that at that time the stock is going to be getting ready to move up again. So that is a look at Square. Square, PayPal, and PayPal gets analyst upgrade. Their earnings were a tiny little miss, and we think you buy the dip on that one also. And we think these stocks are much better than the other stocks in the credit card category. Visa, MasterCard, we think that those have a lot of risk in here right now, and we've seen Discover and some of the other credit card companies, Capital One, start to struggle. So much prefer Square and PayPal. So that is the best stocks for the week. The worst stocks for the week, well, again, we had a lot of moves and a lot of big moves, and I'm going to show you 5 of them, but I got a lot more to talk about because there was a lot that was going on. So we're going to switch now and look at Xilinx, XLNX. This was the biggest decliner, 12% on the downside. Now, just as I showed you favorable patterns, and you can see favorable patterns and unfavorable patterns in here very clearly, this is what I consider to be a very unfavorable pattern. So you can see this was positive, right? And that set up another big move, and it flew. Then you have this big shooting star made the top, and it broke underneath this key low. That then gives you a negative configuration. It says that the next rally is likely to fail at resistance. In this case, it failed at the 34-week moving average. You could see the 34-week was support over here, and then turned down and broke this low. We have this downward trend going on that's established by lower highs and lower lows. It's due to bottom in about a week. You could project in about a month, sorry, and it's projected to come down and touch that major 78.6. We would give it about another 6 points on the downside, and the likelihood that this next month that any attempted rally will fail in there. That means it's a setup for short side traders. 12% down on a big earnings miss. Analysts are downgrading the stock in there. Next stock we're going to look at in there is BZH. So the home builders have been doing relatively well and making higher highs, and even Beazer did that. And when you look in here, what I have is a comparison. The XBH is that dashed line right there, and the Beazer pattern is right here. So you can see it tracks the group pretty closely. Now what we have in here is a breakdown, as we have this low right over here, that key low, getting broken down right here. And when it does that, it says that it's likely to decline through this entire declining phase of this cycle right here. That says you have lower prices coming for about another 4, 5, 6 weeks in here in Beazer. And this big earnings miss in there, really big. Analysts downgrading the stock. And when you look at this, you might as well just say bye-bye Beazer, because there's hardly a way that this can go up without any really crazy news coming out on the stock. Earnings already out, already bad, and in my opinion, in a breakdown and likely to see much lower prices ahead. Maybe lower interest rates. Don't do it when you get into situations where economies can slow very sharply. And we're headed to sub 1% interest rates in this country. And I don't think that the home builders will do that well under those conditions because things will be so bad. Schnitzer Steel, SCHN, is the next one we're going to look at, and representative of a very disastrous group. You can see in here as I look at these three cycles, it follows the DBB or the base metals very closely, and copper is collapsing. The steels all look really bad. U.S. Steel looks really bad. It came down to $9. Here is Schnitzer down 11% on the week. No news at all except for worldwide economic slowing and crashing metals prices. This is not, of course, a good pattern. Again, you can see what happens is that it breaks the key low and then gives you a bear signal. And then what happens is that you create a sell zone that it fails from, and then it goes down again. It broke this key low and then free fell again. So what we have is this stair-step downward pattern going on. The sell zone's working tremendously well. And this downward pattern still going on. It probably goes on all the way out until June over here, or July, based on these patterns that I see in here. So attempted rally is likely to fail. We have listed a couple of stocks in this group that we thought would decline and set up some buys. And I want you to look at Rio Tinto and BHP Billiton. I think that once we get past the coronavirus crisis that we're having right now, and things settle down, I think those stocks are going to be in better shape. The stocks that are in the industrial category are getting hammered. Triple M is a pretty good representative of that. Look at this week. Huge miss in earnings. This pattern is suggestive of it falling into late March and hitting 150 or lower. This big break in here you see is just investors bailing, and again you can see what happens. Look at the rhythms in here. They're perfect. 23 weeks from the previous low, 21 weeks right over here. Each of these very similar in length, and this one due to bottom in about 4 to 6 weeks. So a lower price is coming in here. Best case I see is 150. It could go significantly lower than that. Look what it did. It tickled the sell zone right over here. It got higher than I would have guessed right over here, but back at the same sell zone level, and then absolutely collapses. Borg Warner down about 10%, Caterpillar down about 3%, and that's after earnings beat, but their guidance was weak in Caterpillar, and I think Caterpillar is going to head down towards 130 support pretty soon. So you can take a look at that one also. Another stock here I want to look at that had a pretty good loss is UPS. I talked about this stock on Thursday when I did a video on the transportation category, and I looked at four groups or categories of stocks in there: the airlines, the truckers, the shippers, and the railroads, and gave you a very clear analysis. So watch that in our stock sectors category, and you'll get a ton of information. UPS. Look at this. I mean, just fantastic. After the breakdown right over here, after this breakdown, we just put in, when it gets close there, we start putting in these warnings that, you break this and you're in a lot of trouble, and you can see. So we have some minor cycle patterns right in here. This one probably bottoms, gives you a little bounce, and then gets whacked again. We're projecting it to go to under 100. So if it bounces and maybe 106, 108, that would be a short sale entry for me, and then moving down again. And then you get into April, maybe you get a better rebound in there, but we think that this is a major top going on in this stock. You can see this perfect, this is an evening star or an inside down, those three bars right over there. If you go to my video library, look in Tools for Techs, I have a video in there of my 22 favorite candlestick patterns, and you will be able to watch that and learn about the psychology behind each of those as it came out of Japan. Steve Nissen made it famous, and as he brought it here to this country. And you can learn a lot about my favorite candlesticks in there. Also, I have a video in the cycle workshop on candlestick patterns and cycle analysis, which are work together very well. So you want to watch that. You know, our video library has got 500 plus videos in there in 8 categories. So if you become a level 2 member or higher, you get to watch all of those videos. So that is a look at UPS. Other just stocks to mention are Bed Bath & Beyond down about 9%. It's moving down into our buy zone into that stock, which we think that in just a few weeks may be an opportunity to be moving up again when we get past this debacle in the stock market we see. And Devon, that was down about 8%. Hess down about 8%. And these were, Hess had a big miss on its earnings and a breakdown on there, and we think Hess is going to move down for about another 4 to 5 weeks also. So that is excuse me, our best and worst stocks of the week with a lot of added information in there. I hope you like that. Don't forget to give us a thumbs up if you watch this on YouTube. All right, so now what I'm going to do is I'm going to move into the short-term view for the coming week. We look at a lot here at askSlim. When we do our Future Speak video on Wednesdays, we look at 6 segments of the market, 24, 25 different futures contracts. And here on Friday, what I do is only bring the main ones. So I look at light crude, the gold market, dollar, the 30-year bond, and the stock index, specifically at the S&P 500, SPX. So what I do is I look at the coming 1 to 3 weeks and then show you our analysis and tell you what the sum of the evidence really is telling you. I rate myself based on how we've analyzed the markets, based on the cycle patterns and important levels and directional changes, and generally try to get to about 60-65% accuracy, about 2 to 1, which is fantastic. And talk about fantastic, we were about 80 to 85% this week. If we had a miss, it was in the bond market, which we thought would rally and then come back down. Well, it just didn't come back down, but we had upgraded our targets in there. And light crude, which we thought would come down and then bounce into a temporary low, and that one really has not given a bounce yet. So we get a dinger on that one also. But overall, we said light crude down through all of January and sell bounces. We just didn't get one in the last week. So now what we're going to look at are these 5 charts, and we're going to switch over to the daily chart. And we're going to start out in the daily chart of light crude, CL. And you can see the free fall going in there right now. It's hit this support right there, and this cycle right over here is late. So in other words, it's run by about 1 or 2 days past it time-wise. That's well within the principle of variation, and that normal variation tends to be longer when it's moving down, and that it bottoms a little early when it's moving up. So there's still a lot of sellers in here. Momentum, we talked last week, it turned negative, and when it turns negative, it really can accelerate to the downside. The projection oscillator in here is showing a lot of weakness. It's not able to get overbought at any time. So we didn't really get any confirmation signals to the weakness out of there other than the fact that it's really just weak, and you can see that. So what we're looking for in this next week, and again, we're projecting out 1 to 3 weeks, is that it's going to begin a rebound in here. This projected rebound is to about 54.5. And then getting slammed again. Some of the evidence is that the risk remains until end of January or early February. The intermediate patterns are in decline. All time frames of momentum are in negative, and it is very likely that rebounds will fail. We're going to look for an attempt at a rebound to start, but we don't think that that will be able to continue. The next thing we're going to look at is the gold market. So we said gold would move up towards 1600. It got up today to the highest part of the week, about 1595. We would say that was accurate. We talked about the positive momentum continuing, and also the fact that when it got oversold right over here on the projection oscillator, it confirms that it's about to move up again, and you can see that it did that. So that was a confirmation of the positive momentum. And again, we talked about momentum, and understanding momentum is the key to success in the world we live in here in the markets. And that's why the new Slimulator momentum tracker is so important to your trading and investing. So this upward movement we're getting probably can last into some part of next week. We're going to look for it to get up between 1600, 1610, something like that, and then begin to get into these corrective phases over here. Now, the dollar weakening could extend this and get it up above that 1613 area, so maybe it's 1620 that it can get up to, and then begin to roll over. We're going to look for up and then rolling over, and over the next couple of weeks, seeing both moves, coming up and then correcting down, and then this being a buying opportunity when it does that. Some of the evidence says it's still in this rising phase. That the fact is that it's only up a little bit today, 250, and that is a weakening relative strength compared to the stock market, which is in free fall today, and the dollar, which is moving down sharply today, but this is only gaining 250. So we need to note that the two influences that could move gold up are not moving it up in a significant way. And the rest of the industrial metals looking really horrible. Gold maybe will not be allowed to move up that much based on what we're seeing in here. So the overall negative picture or potential deflationary picture may keep gold from making a giant move now. Now, we have much higher projections later in the year, but still we're only looking here at the short term over these next weeks. And to us, that says attempted rallies, but then probably getting into a corrective period in here. We're going to look for late February, the potential for it to move down, maybe 1550, 1560. As we project out a few more weeks after this peak is made that we're expecting in here. That is a look at gold. Dollar sign DXY. As I said earlier in the show, the dollar has moved down. You can see those last 2 days in here. And that is a factor of falling interest rates and the relationship between the U.S. interest rates and the rest of the world. The rest of the world at zero or negative, U.S. interest rates much higher. It's had money coming into the United States, and that's why the dollar is held so well in this range that we've had here. And you can see all of these cycles as it's held between 96 and 99. That is an extremely narrow range that it's been in. And now we think that is, down the road going to come to an end. We'll probably see the dollar in the next year or two well below 90. But in the meantime, this is just a short-term view. So what we're looking for is a bottoming coming in here. We're in the support zones, another attempted rally, maybe not as high as I gave it right over here, but kind of range bound between 97.20 and maybe 98.40 over quite a number of weeks in here. That's how that projects. This is a positively configured cycle right over here. Unless in the next 2 days it has a very big collapse, which is not likely, it would then say that there is another rally coming, as you can see in this rising phase here. Look at the rising phases here, this one and this one and this one and this one. All of those bring you rallies. So this is a concern for gold when you look at that, because gold isn't rallying when the dollar is falling. So that might mean that when the dollar rebounds, and the dollar will rebound if the bond market pulls back, which I think is going to happen, then we will then likely see the gold market under pressure. We're going to call the dollar attempting to rally back, short-term bounce. Momentum in here, as you could see, positive, but beginning to fail, but not having failed yet. And some of the evidence is that it failed an important intermediate resistance, and the range we're looking for really, or some of the evidence says that we are likely to be range bound over the next month. A big factor will be the movement in interest rates. And overall, we think the dollar has made a big top, and that's a function of the fact that we think that interest rates are going lower. And the market's going to force that hand. So that is a look at the dollar, and now we're going to switch over and look at the 30-year bond. So we said interest rates are going lower. That would mean bonds are going higher. But in the short term, we think it's going to run out of gas. Now, as long as the stock market is plunging, there's a pretty good probability that the bond market will not give a lot of ground. Now, right now, the S&Ps are down 57, and the Nasdaq is down 133, and the bond market is up. And the bond market is not really gaining any ground after this morning. And I don't think that there's a lot more in here on the upside when I look at this. We're going to look for bonds to peak fairly soon. If the stock market gets any rebound, I think the bond market will start to pull back. Our projection now is for the bond market over the next couple of weeks to pull back and make only a little bit of upside ground, potentially maybe 64.20 up there, and that's where that resistance is from the weekly chart right over there. I want you to note that this is the second week that we have upgraded the projections in here. In other words, the decline that would come in this declining phase would be to a higher level. We were projecting as low as 55. And then we raised that to 158, and now we're raising that again to these levels right over here at about 160.16, 160.15, right there over the next couple of weeks. So we think that once the stock market gets a little stability, this bond market will be pulling back in some significant way. But we think that will be temporary, and then bonds will start moving up again. And if you watch our year-end show, we talk about sub 1% interest rates in the 10-year, and that's, of course, much further down the road. Some of the evidence is that there's a potential move to 164.20, and that the odds are pretty high that it will stall in that area based on intermediate resistances and give you some kind of a pullback. That is a look at the bond market. So the stock market is in free fall today. The free fall actually began a couple days ago or a few days ago, and the timing for this peak was just extraordinarily good based on what our anticipation, our projected peaks were that we put out weeks and weeks and weeks ago. And it's remarkable that the coronavirus news comes out just at this time, and sometimes the news just does fit the patterns. So we're going to look at the SPX as representative of all of the index futures or all of the index markets as we switch over from the bond market to the S&P 500. Now, we had looked for this decline right over here to come earlier. So I want you to note that this is a little bit late right over here. That might push this decline out a little bit past this nested area right there. You can see we have it a couple days past right there, because this was a 12-day minor cycle right over here, and we're getting a little lengthening and shifting. And this so far is 4 days only. So we expect this to be 10 to 12 days. That gives you, let's say, 5, 6, 7, 8 days of decline right in here. And our projection was, right down here to about 32.20, the top of that intermediate support. It really makes sense to be to 31.50. So we're looking at that over this next, 2 weeks really. And then some false bounce right in here, and then another big down wave, which takes you in towards that end of February, March. All of this right over here is what we've been projecting for weeks and weeks, as we expected that the market would peak and then go into a serious intermediate correction. Now, our projections for the year are only 8 to 12% on the downside. That's practically bullish. So that's would be a very mild year after having 11 bull market years. and a year that barely could give any ground last year. So all of this, what you're looking at here, these big declines right there, well, that's optimism. I know you're going to get a chuckle out of that. 3150 is our a near-term target, and then we'll have our lower targets in there once this all develops right in here, and we see the formation, and we see how far it can rebound right in here. Then we'll have our next projections to the downside. Look at this, hits the sell zone right there, and then comes down and takes out this low. It confirms that we are in this declining phase. 3150, a very reasonable target here in this next, we'll just say 6 to 8 days, right over there, and a lot of trouble for this stock market right now when you look at that. European markets, world markets leading, and the recalcitrant bulls out there trying to hold the market together, but really not looking like it. We're going to call a down week coming up, maybe choppy down week, because remember, we're getting 50, 60-point moves in days. Momentum has weakened. Now, this is significant right in here. This, and if you look at our momentum indicators, for those of you that get our charts, you'll see this is now turned purple, and we're likely to see this turn to negative pretty soon. So we had a positive momentum condition that began way back over here. So let's just look at this whole period right over here. This is where the positive momentum condition began with the S&Ps at around 29.75. They continued all the way up here to 33.37 right there. All of these projection oscillator buy signals or strength signals were great. Now we're going to get into a condition where we're likely to begin to get sell signals in there. So all of this period of positive momentum ended as of today, and that is a very significant occurrence. We're going to be looking for downside in here as we have projected in this market. The sum of the evidence is that we have an intermediate top in place. When you get down and to break down levels in the short term, it's like a domino effect. So the intermediate turned negative first, the daily then turns negative, and then it affects the weekly. Some of the evidence is that an intermediate top is in place. It declines to late February, early March, and that the next basically 6 to 8 days point to further declines, followed by a modest bounce. That is it, man, that I bring you a lot today. Do become an askSlim member. Give us a thumbs up on this video on YouTube. If you want to be a premium member and get all of the amazing content that we have out there, write to Matt at askSlim.com and request our trials and levels 2, 3, and 4, depending on what you want. Just go to our website. You can take a peek and see what we have there. I want you to be so careful because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm going to